What's going on YouTube? It's Lynn Matheson, aka the Canadian Cottage Girl, and today I'm joined by Ryan Carson, and we are in the Carson Law office, and we're going to be breaking down whether or not you should consider incorporating your real estate business or not, and break down the pros and cons between active and passive portfolios. So you're not going to want to miss this video today.
Because a significant driving factor is going to be, are there going to be tax benefits here? Because there will always be a legal benefit to incorporate. There's things you can do with a corporation you just can't really do personally.
Before we jump into today's topic, make sure that you smash the like button. It really helps us out and boosts the video. It, speaks to the algorithm gods of YouTube. So make sure that you smash that like button. Also, subscribe to the channel so that you don't miss a single beat here on the Canadian Real Estate channel. Well, Ryan, welcome to the channel.
It's a pleasure to be here.
Absolutely. Well, I'm excited about this topic because a lot of investors kind of go through this contemplation of, should I incorporate, should I keep it in my personal name? So let's first start by determining whether or not they should based off of what type of portfolio they have. So what's the first question that an investor should really be asking themselves when they're considering whether or not to incorporate?
Right. I think one of the first questions, at least from our perspective, and I think it's important for everybody who watches this video to realize this is just coming from the lawyer's point of view. Obviously, you want to have a really strong power team. That would include, among others, your accountant, your tax advisor. And so I think it's really important. Your tax advisor, the accountant, really has to play a very integral part in this discussion, incorporate or not, right? Because a significant driving factor is going to be, are there going to be tax benefits here? Because there will always be a legal benefit to incorporate. And what I mean by that is when you incorporate, you've created a new legal person. Just like you and I are legal people and persons, a corporation becomes its own legal entity recognized by law and taxes and so forth. And so when you create that corporation, you've separated essentially yourself personally and your assets and your liabilities personally from the corp. So if the driving force behind incorporating is, I want to incorporate even irregardless of tax benefits because I want to make sure all my personal assets and possible liabilities are excluded and separated from my corporate and my business, then you have your answer. You'd want to incorporate, right? Mostly though, most of the time, most investors, that's important to them, but it's not the driving factor. Normally I find most investors want to know from that accountant, was it going to save me any money? Is it going to make my business more efficient, on expenses and write-offs and budgeting and taxes? And is it going to mean a larger net dollar in my pocket or the corporation's pocket at the end of the day, right? And so that's where the tax accountant can really chime in. And they usually, and again, I'm not a tax expert, but they usually will ask it from a standpoint, like you said, of active or passive income, which is going to come heavily from the types of projects people are trying to do in their portfolio of investing. Right? So if it turned out you were doing things that were very passive in nature, you're buying and just renting to tenants, would be the most common. Or you buy maybe a speculation property and then you just flip it on a sale, maybe on like an assignment deal. Those are probably, again, not an expert in tax, but they'd probably say that categorizes more in passive than if you did something active, like you bought it and you did the BRRRR method, where you buy it, you do a whole bunch of renovations, restorations, refinances, etc. and so forth, and now you're renting it out. You'd have some active component there. or land development, right? If you're getting into land development or just buying, tear down, rebuild, like there's obviously a lot of active components there that I think the tax accountant would say, oh, well, there's definitely some active income happening here, so I can really see how incorporating makes sense. Right? So that's a big consideration for incorporating. So you've got a couple things that we've just talked about. Do you want to separate personal and business assets and liabilities? So that's incorporation possibility. Is there going to be tax benefits, and do the accountants recommend it because it's going to create tax efficiencies and so forth?
Absolutely.
Which is your active passive. The other consideration, which I've just thought of while we're chatting here, is there could be other planning mechanisms that make the incorporation attractive to the investor. And again, not pretending to be an expert in these areas either, but to help give information out there to all the people watching. There's things you can do with a corporation you just can't really do personally, not to the same degree and scope. One thing is you could have a corporation own corporately owned insurance, life insurance. And these corporately owned life insurance policies can be very specialized. So not like what people think of when they think of life insurance, oh, I'm gonna die, I better get some life insurance, get some term life insurance, very generic, very basic, right? What we're talking about here is making so we have corporately owned insurance owned by the company for the benefit of the owners, and there could be like cash values. So there's like a cash value you can lend against these kinds of policies. Yes, it has the generic life insurance payout that you would expect in life insurance, but there's cash to it, there's values to it. It can be invested at a higher rate of return than you can with a lot of other investments because it's under the Insurance Act. So there's a lot of, and that's just one type of planning piece that you can do if you have corporate structure. Right? I mean, there's multiple other estate planning opportunities. Like you can have a primary and secondary will, or sometimes people call it personal and corporate wills. And the benefit there is, let's say you chose not to incorporate. And under your business umbrella, you had $1 million of value, right? Net value. If you suddenly die and everything's under personal, then the administrative tax of the estate on that $1 million is going to be $15,000. However, and that's just free money to the government. However, if you did incorporate and you put that into what is called the secondary will or a corporate will, now that $1 million of value is exempt of that administrative tax. So you just saved your estate $15,000. So there's everybody looks, I think, first and foremost, which they should, at the 2 points we talked about originally, which is it going to save me tax? And how do I protect liability and assets personally and corporate? But I think there's lots of other layers that once you start diving into an experienced real estate investor like Power Group, lawyer, accountant, planner, coach, etc., you're going to find you can really peel back a lot of other benefits that might make you reconsider the concept of incorporating. Lots of other benefits to it.
Absolutely. Well, it sounds like there's some pretty key points that you should consider if you're going to incorporate or not. One being the liability piece, as you mentioned, just the breakdown of whether or not you want that personal liability or for that to be in a corporate entity with your investments. The second one was really whether or not it's actually going to save you taxes, or what your actual why or type of portfolio is that you have. So whether that's super active or very passive passive in nature, and that will definitely determine the pathway that you go with this corporate structure or not. And then the third would be future pacing and future planning. So really understanding what your long-term goals are with your estate, or what your long-term goals are with your investment portfolio, so that you can really identify, not just in the interim, in the right now when you're buying a property, but long-term what your plans are and what you want the whole umbrella to look like. So I think that if you have a question about any of these topics that we've gone over today, just make sure you throw it into the comments section below. And Ryan, do you have anything to add to that whole topic or umbrella?
I mean, anyone can call me anytime at the office, or check us out on our website, carsonlaw.ca. My email's there. I'm happy to set up separate conversations and consultations with anybody who has deeper questions.
Awesome. Well, guys, make sure that you reach out if you have any real estate investing questions to Ryan and his Carson Law professional team. So their information is just going to be in the comments section below. Again, make sure that you throw us some love in the comment section if you have any questions at all, and smash that like button. It really helps us out and lets us know that you're enjoying the videos. And reminder that you gotta turn on that notification bell in order to not miss a single video, and subscribe to the channel here on the Canadian Real Estate channel. Well, Ryan, thanks again for tuning in and hopping onto this video just to break down the different corporate structures and whether or not you should consider incorporating your real estate investing business.
Thank you. My pleasure.
Thank you. All right, we'll see you guys on the next one. Peace.